How are you, friends? I hope you are all doing well. Today I am going to tell you a story from 1770. And while I tell you this story, keep one thing in the back of your mind. This is not just a history lesson. This is exactly what is happening right now in your retirement account. Are you ready? Let us begin. In 1720, there was a man named John Law. This man went to France and said, "Give me the authority to run the national bank and I will save your economy." The French government, crushed under the enormous debt burden created by wars, accepted this offer. Well, desperate people sometimes make strange decisions, right? Law created a structure called the Mississippi Company. This company supposedly owned valuable land in Louisiana. He issued shares and printed money. People were getting rich. On paper, the share price jumped from 500 livres to 18,000 livres in less than 2 years. People in Paris were selling their jewelry, their homes, everything to buy these shares. They were keeping watch outside the man's house. Now stop here for a second. In how many cases throughout history did things end well when you heard the phrase, "everyone is buying"? Exactly 0 times. And what about those Louisiana lands? They were swamp, pure swamp. No gold, no trade, no income. Law was just printing money and paying returns to earlier investors with new investors' money. A classic scheme, but Law knew it was unsustainable, so he started printing even more money. The French government loved it because their debt was disappearing. They gave him more power. Then in 1720, people started asking questions. They wanted to convert their paper shares to gold. Law did not have the gold. The bank could not honor the conversion requests. Within 6 months, the shares fell from 18,000 livres to 500, then to 0. People who had been millionaires on paper went bankrupt. The French economy collapsed so hard that they banned paper money for decades. Law fled the country and died broke in Venice 9 years later. Who won? The French government offloaded enormous debt onto private investors who were left holding worthless paper. A handful of insiders who got out early walked away with their wealth intact. Who lost? Virtually all of France, middle-class families, small business owners, people who believed the system would protect them. And the most bitter part, the bankers and government officials who enabled Law faced almost no consequences whatsoever. They simply moved on to the next scheme. Now you are going to ask, "Owner, what does this 18th century drama have to do with us?" Friends, it has everything to do with us. Because right now, you are being sold the exact same concentrated bet. Except instead of Louisiana swampland, now there are 7 technology companies. Imagine you are building a house. The contractor says we will use the best materials. Great, right? Then you find out that 70% of the house, the foundation, the walls, the roof, all rests on 7 wooden beams. These beams are currently the strongest beams on the market. But you are thinking, what happens if 3 of these beams crack? The contractor says, do not worry. These beams have been getting stronger every year for 15 years. Would you live in that house? Would you raise your children there? Because this is exactly the situation of your index fund. As of early 2026, the S&P 500 index, the thing every financial advisor tells you to buy and hold forever, has more than 30% of its total value concentrated in 7 companies. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, 7 companies out of 500. 1.4% of companies holding nearly a third of the total weight. In the 1990s, the top 7 companies had maybe 15% of the share. We have doubled the concentration in 25 years and everyone is acting like this is normal. Double in 25 years. I would love to hear someone explain to me how this qualifies as diversified investing. Now you might be thinking, okay, but these companies are massive and profitable. They print money. True, but so did the Nifty 50. Let us go back to the early 1970s. The Nifty 50 were 50 stocks that every institutional investor said you could buy and never sell. Blue-chip American companies like Polaroid, Xerox, Kodak, Avon, Sears. The idea was that these companies were so dominant, so well managed, so essential to American life that you did not even need to look at the price. Growth was guaranteed. These stocks were trading at 50, 60, even 80 times earnings, which is an insane figure. But people said it does not matter. Growth will catch up. Then 1973 came. Oil crisis. Inflation spiked. Recession hit. Suddenly growth stocks were not growing. The Nifty 50 crashed. Polaroid fell 91% from peak to trough. Avon 86%, Xerox 71%. These were not speculative startups. These were the safest companies in America. And if you bought at the peak in 1972, you had to wait 25 years just to break even on some of them, not counting inflation. A quarter century of zero returns. On the safest investments, do you know what happened? Let me walk you through it step by step. First, institutional investors decided that a small group of stocks was so good that valuation did not matter. Second, they poured money into those stocks, pushing prices higher and higher. Third, the high prices became evidence of quality, creating a feedback loop. Fourth, when economic conditions changed, those overvalued stocks had the furthest to fall. And fifth, the diversification everyone thought they had disappeared because all the safe stocks crashed together. But here is the part nobody talks about. Who made money? The company executives who sold shares at the peak. The investment banks that underwrote the offerings and collected fees. The early investors who got in at reasonable prices and got out before the crash. Who lost? Ordinary people who bought at the top because their financial advisor said it was safe. Pension funds that needed steady returns. Retirees who thought they were being conservative. And the most surprising twist, the financial industry learned nothing. They just waited 20 years and did it again with tech stocks in the late 1990s. Then again with housing in 2007, and now again with mega-cap tech in 2026. So what does this pattern look like today? Let us talk about Nvidia. Incredible company, genuinely revolutionary technology. Do not think I am criticizing them by saying this. But in 2023, Nvidia was worth around $300 billion. By early 2026, it crossed $3 trillion, that is a 10 times increase in under 3 years. Revenues grew, yes, but not 10 times. What grew 10 times was the multiple investors were willing to pay. This is exactly what happened with Polaroid in 1972. Now you are going to ask, is Nvidia overvalued? Maybe, maybe not. That is an entirely different question. The real point is that your index fund is now massively dependent on Nvidia maintaining that valuation or going higher. If Nvidia drops 50%, which is what has eventually happened to every high-flying tech stock, that alone takes nearly 5% off the S&P 500. Add similar drops for Apple, Microsoft, and a couple others. And you are down 20 to 30% even if the other 493 companies do just fine. This honestly worries me a bit. And I am not the only one who is worried. Here is where it gets really interesting. The system is designed to hide this risk from you. Here is how. First, they call it diversification. You own an index fund with 500 companies. That sounds diversified. But if 7 of those companies are a third of your money, you are not diversified. You are concentrated. It is a linguistic trick. Second, they use market cap weighting. Sounds technical and smart, right? All it means is that the stocks that have already gone up the most get the biggest share of new money. You are automatically buying more of what is expensive and less of what is cheap. The exact opposite of what every successful investor actually does. Third, they show you long-term charts that smooth out the crashes. Yes, the market always recovers eventually. But eventually might be 25 years, and you might not have 25 years. Let me give you the emotional reframe you need. You are not a passenger in this system. You are the product. The financial industry makes money from fees and volume, not from your returns. When they say buy index funds and hold, what they mean is give us your money and do not ask questions for 30 years while we collect our percentage regardless of what happens. I am not saying index funds are evil. I am saying blind index investing in 2026 means playing a game where the rules are rigged against you. So if I were starting fresh right now, knowing what I know, here is exactly what I would do. Taking into account what I know about how markets actually work versus how they are sold to you. Action step 1. I would check my actual exposure right now. Not what I think I am exposed to, what I am actually exposed to. If you own an S&P 500 index fund or a total market fund, go look up the top 10 holdings. Add up the percentages. If it is more than 25% in the top 10, you are concentrated, not diversified. Most people have never done this. They just assume index fund equals safe. Go look tonight. Whoever you use, they all publish their holdings. 5 minutes. Do it. Action step 2. I would implement what I call the inverse concentration strategy. Here is how it works. Instead of letting market cap weighting automatically put 30% of my money into 7 stocks, I would manually create a position that does the opposite. You can buy equal weight index funds where all 500 companies get the same allocation, regardless of size. Or you can buy international developed markets which are trading at 15-year low valuations compared to US stocks. Or you can buy small and mid-cap value stocks which have historically outperformed large-cap growth over 20-year periods but have been left behind for the last decade. I am not saying sell everything and go all in on small-cap companies. I am saying, if the market is automatically concentrating your risk in 7 companies, you need to manually rebalance that risk somewhere else. If 30% of a standard index is in mega-cap tech, maybe 30% of your portfolio goes into things that are negatively correlated, or at least emerging markets, commodities, real estate investment trusts that actually own physical property, Treasury inflation-protected securities, if you are worried about inflation coming back. Here is the math on why this matters. Let us say you have $500,000 in a standard S&P 500 fund. About $150,000 of that is in the big 7 tech stocks. If those stocks drop 50% over the next 2 years, which is what happened to the Nifty 50 and what happened to tech stocks from 2000 to 2002, You just lost $75,000 from that concentration alone. The other $350,000 might stay flat or drop less, but you are still down 15% overall just from 7 stocks. Now imagine you had rebalanced 6 months ago. You moved 75,000 of that 150,000 into equal weight or international or small cap value. Those alternatives might also drop, but they will not drop 50% because they are not as overvalued. Maybe they drop 20%. Now you have lost 15,000 instead of 75,000. That is $60,000 of protection just from recognizing the concentration risk. But now, you might be thinking, what if those 7 stocks keep going up? What if Nvidia hits 5 trillion and I miss out? Here is the thing, you have to decide what you are optimizing for. Are you trying to maximize your upside if the current trend continues forever? Or are you trying to build actual wealth that survives different market conditions? Because nobody, and I mean nobody, can tell you when the music stops. John Law's Mississippi Company looked like a sure thing until it did not. The Nifty 50 looked unstoppable until they stopped. Housing prices only go up until they go down. I would rather make 70% of the gains in a bull market and avoid 70% of the losses in a bear market than swing for the fences and risk losing everything. That is not being scared, that is being smart. The people who got rich and stayed rich are the ones who did not blow up. I have thought about this a lot and I always arrive at the same conclusion. Action step 3. I would set up what I call valuation tripwires. These are automatic rules that force me to rebalance when things get crazy because in the moment you will not want to. In 1999, people who sold tech stocks looked stupid for 2 years. Then they looked like geniuses. You need rules that remove emotion. Here is an example rule. If any single stock in my portfolio becomes more than 8% of my total account value, I automatically sell enough to bring it back to 8%. If the S&P 500 price-to-earnings ratio goes above 30, I automatically move 10% of my stock allocation into bonds or cash. If the top 10 holdings in my index fund exceed 30% of the total, I rebalance into equal weight. These are not market timing. These are valuation discipline. You are not trying to predict crashes. You are limiting your exposure to expensive assets and rebalancing into cheaper ones. This is what every successful endowment and sovereign wealth fund does. But retail investors are told to just buy and never sell. Action step 4, and this is the one nobody talks about. I would build an income floor outside the market. This is psychological as much as it is financial. The reason people panic sell at the bottom is because they need the money. The market is crashing, and they have no other option. If you have 12 months of expenses in a high-yield savings account earning 4 to 5%, and you have some dividend-paying stocks or bonds generating even a small amount of income, you can survive a market crash without selling at the bottom. You can wait it out. You can even buy more when things are cheap. Here is the math. If you spend $60,000 a year, you need $60,000 in accessible cash or equivalents. Yes, that is money that is not compounding in the market, but it is insurance that lets you stay in the market when everyone else is forced out. During 2008, people with cash bought stocks at 50% off. People without cash sold at 50% off to pay their mortgage. Same event, opposite outcomes, entirely based on having a buffer. When I first learned this, I found it truly striking. To people experiencing the same news, the same crash, coming out with completely different results. The only difference, one was prepared. I would also look hard at building income streams that are not tied to my portfolio value. A side business, rental income from real estate, royalties from something you create, even a part-time consulting gig in your field. The goal is that if the market cuts your portfolio in half, your life does not fall apart. You are not desperate. Desperation makes you sell low and buy high, which is how wealth gets transferred from regular people to institutions. Action step 5. I would get really honest about my time horizon. The advice to buy and hold for 30 years is great if you are 25. If you are 45 and planning to retire at 60, you do not have 30 years to recover from a crash. You have 15 years. And if a major crash happens in year 10, you are in serious trouble. The sequence of returns matters as much as the average return. 2 people can get the same average annual return over 20 years. But if one person has a crash right before retirement and the other has it early in their career, the first person runs out of money and the second person is fine. If you are within 10 years of needing the money, whether that is retirement, buying a house, or funding a child's college, you cannot afford to have 30% of your portfolio in 7 stocks priced for perfection. You need to de-risk even if it means lower returns, because losing 25% at 55 is not the same as losing 25% at 30. At 30, you have time and income to recover. At 55, that loss might be permanent. Here is the bigger picture. The financial industry has spent 40 years convincing you that investing is complicated and you need experts. Then the experts tell you to buy index funds and do nothing, which is the least complicated strategy possible. Why? Because it is profitable for them and easy to scale. They are not wrong that index funds are better than picking individual stocks for most people, but they are lying by omission when they act like all index funds are the same and concentration risk does not exist. Just like John Law convinced France that paper money backed by nothing was the same as gold, the financial industry has convinced you that an index fund with 30% in 7 stocks is the same as diversification. It is not. It is a concentrated bet on the continued dominance of a handful of companies that are trading at valuations that have historically preceded major crashes. So am I saying those 7 companies are going to crash tomorrow? No, I have absolutely no idea, and neither does anyone else. Microsoft might be worth 10 trillion in 5 years or might be worth 1 trillion. What I am saying is that if you are not aware of the concentration, if you are not actively managing that risk, you are making the same mistake that people made with the Mississippi Company, the Nifty 50.com stocks, and housing. You are assuming that what has worked recently will work forever, and you are ignoring the structure of the bet you are actually making. Let me tell you what the smart money is doing. And by smart money, I do not mean hedge funds doing crazy derivatives. I mean endowments and foundations that need to generate returns for decades without blowing up. Yale's endowment, often considered one of the best managed pools of money in the world, has less than 10% in U.S. stocks. 10%. The rest is in private equity, real assets, foreign markets, absolute return strategies, things that do not move in lockstep with the S&P 500. They are not trying to beat the index every single year. They are trying to compound wealth across different economic environments without catastrophic losses. You cannot replicate Yale's endowment as a regular person. You do not have access to the same investments, but you can replicate the philosophy. Diversify across asset classes that do not all crash together. Do not let any single bet, whether it is a company, a sector, or a country, become too big. Rebalance from expensive to cheap. Build income sources outside your portfolio. Boring, I know, but boring is what survives. Here is what I would avoid in 2026. I would avoid anything sold as you cannot lose, or guaranteed returns, or as safe as the market. If it sounds too good to be true, it is. I would avoid trying to time the market by going to cash and waiting for a crash because you will miss years of gains and probably get back in at the wrong time anyway. I would avoid complex products I do not understand. If you cannot explain to a 12-year-old how it makes money, do not put your savings in it. And I would avoid the temptation to do nothing just because doing something feels overwhelming. Doing nothing right now when concentration is at historic highs is an active choice to accept that risk. It is not neutral. You are not being patient. You are being passive, and there is a difference. Let us talk about the psychological shift that needs to happen. Most people treat their portfolio like a plant. Water it with regular contributions. Leave it in the sun. Check on it once a year. Hope it grows. That worked great from 1980 to 2000 and from 2009 to 2021. Because there were multi-decade tailwinds of falling interest rates and expanding valuations. But those tailwinds are over. Interest rates are higher and unlikely to go back to zero. Valuations are already at the top end of historical ranges. You cannot just plant your money and forget it anymore. You have to treat your portfolio like a garden. You still plant and water, but you also weed, you prune, you rotate crops, you adapt to the seasons. That does not mean daily trading or obsessing over every headline. It means quarterly check-ins where you look at valuation, rebalance what has gotten too big, trim what is expensive, add to what is cheap. It is active management in the sense of being engaged, not active trading in the sense of constant buying and selling. The reason this matters emotionally is that when the next crash comes, and it will come because crashes always come, you need to know that you did something. If you just bought a standard index fund and hoped, you are going to feel like a victim when it drops 30 or 40%. You will panic. You will sell at the bottom. You will swear off stocks forever. But if you have already taken steps to reduce concentration, to build an income floor, to diversify across assets, you will feel like you prepared. You will not be happy about the losses, but you will not be destroyed. You will be able to hold on, or even buy more. And that is the difference between people who build wealth through cycles and people who get wrecked. Here is a scenario to make it concrete. It is late 2027. There has been some kind of shock. Does not matter what. Recession, geopolitical crisis, tech regulation, whatever. Mega-cap tech stocks drop 40% in 6 months. The S&P 500 drops 28% overall. Your coworker who has everything in a standard index fund and needed to retire in 2028 now has to work 3 more years because their portfolio went from 900,000 to 650,000. They are angry. They are scared. They sell half of what is left and put it in cash, locking in the losses. The market recovers over the next 3 years. But they missed most of it because they were in cash. You, on the other hand, rebalanced a year earlier. You moved some money into equal weight, some into international, some into bonds. You kept a cash buffer. Your portfolio drops 20% instead of 28. Not fun, but you knew it could happen. You do not need the money for 5 more years and you have a year of expenses in cash, so you do not have to sell. Actually, you take some of that cash and buy stocks at lower prices. 3 years later, when things recover, your portfolio is higher than it was before the crash. Same market, different outcome because you prepared. When you really think about this concretely, the difference between preparation and lack of preparation becomes this clear. That is what I mean by taking control. You cannot control what the market does, but you can control your exposure, your liquidity, your emotional resilience. Most people give up all three because they are told that investing is either too complicated for them or so simple that they should not think about it. Both are lies designed to keep you passive. Let me give you one more historical example to drive this home. In 1989, Japan's stock market was the largest in the world. The Nikkei index hit 38,915. Japanese companies were buying up American real estate. Everyone said Japan would overtake the US economically. And Japanese stocks were trading at 60 times earnings because growth was inevitable. If you were a Japanese investor in 1989 and you listened to the experts who said, just buy the index and hold, you would have lost 75% over the next 3 years. The Nikkei bottomed around 7,000 in 2003. As of 2026, 37 years later, it only recently got back to the 1989 peak. 37 years of zero real returns. Japan had specific structural problems: demographics, debt, zombified banks. But let me say this plainly, the claim that the market always recovers is only true if you are talking about the global market over a century. Specific markets can stay down for decades. So the lesson is not, do not invest in stocks. The lesson is, do not assume that what worked for the last 15 years will work for the next 15. The US market has been the best performing market in the world. Megacap tech has been the best performing sector. Passive indexing has been the best performing strategy. All of those could reverse, and if they do, the people who were 100% in a market cap weighted US index fund will suffer the most. What would I actually buy in 2026 if I were building a portfolio from scratch? Here is the mix I would start with, and I want to be clear, this is not financial advice. This is what I would do for myself, knowing my own risk tolerance and time horizon. 30% in a diversified US stock fund that is equal weight or tilted toward small and mid-cap value. 20% in international developed markets. Europe, Japan, Australia, places that are cheaper than the US right now. 10% in emerging markets for long-term growth exposure. 15% in real assets. This could be REITs, commodities, infrastructure funds, things that do well when inflation picks up. 15% in bonds, a mix of treasuries for safety and corporate bonds for yield. 10% in cash or short-term equivalents, your emergency fund and opportunity fund. That is 100%. And notice that none of it is in a standard market cap weighted S&P 500 fund. I am not opposed to those funds, but in 2026, given the concentration risk, I would rather build diversification manually. This mix gives you exposure to stocks for growth, international for diversification, real assets for inflation protection, bonds for stability, and cash for flexibility. No single position dominates. If tech crashes, you are not destroyed. If inflation spikes, you have some protection. If interest rates rise, your bonds might suffer, but your cash can be redeployed. You are not trying to predict the future. You are trying to survive different versions of it. Would this portfolio beat the S&P 500 if the current concentration trend continues and those 7 stocks double again? No, it would not. You would underperform, and that is okay. Because if the concentration reverses and those 7 stocks crash, you would outperform by a huge margin. You are trading maximum upside for lower downside. And at a certain point in your wealth building journey, that is the right trade. When you are trying to get your first 100,000, sure, take more risk. When you are trying to protect 500,000 or a million, not losing it becomes more important than doubling it. Here is the final psychological shift. Wealth is not built by hitting home runs. It is built by not striking out. If you can generate decent returns, 7 to 9% a year, and avoid catastrophic losses, you will end up in the top 10% of investors over 30 years. The people who chase 15% returns are the same people who blow up when they hit a bad stretch. Slow and steady actually wins, but only if you are steady through the rough patches. And you can only be steady if you have prepared. So if I were going to invest in 2026, I would start by admitting that the environment is different than it was in 2010 or even 2020. Valuations are high. Concentration is extreme. The easy gains from falling rates are over. I would check my actual exposure and fix any concentration risk. I would build a cash buffer so I am never forced to sell at the bottom. I would diversify across assets and geographies, not just companies. I would set up rules to rebalance automatically so I do not have to rely on willpower. And I would accept that I might underperform in the short run if the current trends continue. but I would sleep better knowing I am not betting everything on 7 companies staying expensive forever. That is it. Not complicated, not sexy, not going to make me a millionaire in 12 months, but it is real. It is based on how markets actually work, and it is designed to survive different outcomes instead of relying on one specific thing to keep happening. Most people will not do this because it requires effort and it means admitting that the default option might not be the best option. But if you are still watching, you are not most people. You are someone who actually wants to understand this and make smart decisions, not just follow the crowd off a cliff. So go check your portfolio tonight. Look at the actual concentration. 5 minutes. Then do action step 1. Then move on to 2. Then 3. Do not wait for big shining moments to be ready, because big shining moments do not come that way. They come through small preparations, and preparation always happens long before the most important market crash, not right before it. Let us get it, friends. If you've watched this far, I want to thank you, my friend. I hope I was able to provide some value to you. Our journey is a long one. If you find my videos helpful, feel free to like the video and subscribe to my channel. Take care of yourself.